David, John just mentioned they're not so focused on the GDP, but the forecast there, as Mona pointed out, is much stronger than consensus at 6.5%. What do you make of that forecast and what Powell's trying to say with that, but also following the path of the virus?
Well, I very much agree with the economic forecast. I don't think there's much disagreement with them in terms of where the economy is going, and it's going to be red hot over the course of this year. I do think that raises the question of when will they begin to taper bond purchases, and I think this makes it more likely that they will begin to taper those purchases early in 2022. You have to say that those numbers for the fourth quarter of this year, inflation above 2%, 4.5% unemployment, over 6% GDP growth, you've got to say that's substantial further progress towards their goals. And then it's just a question of, obviously, most members of the committee, even though they saw themselves at full employment with inflation at 2% and having been above 2% for a while, even though they see that for 2023, they don't want to put that rate hike in there. And I think they're scared about spooking the bond market. But, I'm not sure that's the right thing to do. I mean, the bond market can take it, or at least the economy can take it right now. We're going to have a boom either way. So I'd rather see interest rates go up now when the economy can take it very easily, rather than sometime in 2022 when maybe the economy is slowing down, maybe you've got an inflation problem, you do need to normalize rates. It's much more difficult to do then. So I think they ought to take advantage of this huge momentum that's building in the economy right now to try to get at least some way towards a normalizing monetary policy, because it'll be more difficult later. But I think that's what they're trying to do.
Mona, David seems to be saying that the greater risk is waiting too long to move. Do you see it that way?
Well, look, I think his point that the Fed has to acknowledge that they're making progress towards their dual mandate. They're putting it in their forecasts. Unemployment is improving. Inflation is picking up. And that is, really undeniable, at least this year. But what's interesting, it also extends to next year as well. I think growth is well above potential growth. Keep in mind, potential growth in the U.S. is somewhere between 1.5% to 2%. So when you're looking at closer to 4.5% growth in 2022, also a very strong economic year. So, to David's point, at some point over the next 2 years, it would actually make a lot of sense for the Fed to start thinking about at least tapering some of its asset purchases. The accommodation level that they have right now is really crisis mode accommodation level. This was at the heart of the pandemic. They needed to bring rates to the lower bound. They needed to increase their balance sheet to offer that liquidity. Clearly, we're seeing signs now that we are leaving crisis mode, and we're starting to exit crisis mode. And that would call for a change in the accommodation level. Really, they should do it in a way where they communicate it well in advance, and hopefully the markets can digest it. We're clearly starting to digest higher treasury yields as well. And, in some ways, if you think about it, the higher inflation and higher yields and even higher federal funds rates, it's a good sign that the economy is improving. In some ways, you want a little bit of inflation.
Yeah.
When you look at areas like Japan and Europe that have just been in stagflation, no growth, no inflation, negative rates. It's a healthy sign in some ways to see the U.S. picking up in economic growth, inflation, and perhaps rates.
I want to get David first and then John with a quick observation on how the equity markets have responded to this relatively dovish set of information that they've received. Both the NASDAQ is up and the Dow has jumped. David, is this what you would have expected?
Yes, if the Federal Reserve continues to, what the Federal Reserve is doing and has done for many years is fuel a huge bubble, or a boom certainly, maybe not quite a bubble, but a boom in financial markets. It's still doing it. These super low rates make it easy to finance investments in equities and in fixed income. So I'm not surprised that equities are going up. But again, I think they have to worry about that boom turning to a bubble at some stage.
John, let me get your thoughts on that. Is the market is clearly cheered, or the equity market clearly cheered by what it's seen?
I think the Fed has been very clear that they want to be patient through the reopening, patient this year. They do not want to adjust monetary policy during this period, and they certainly don't want to make it tighter. To the extent some people are worried about that, they should be a little bit relieved today. So it makes sense to me that what you're describing.
Shepard Smith here. Thanks for watching CNBC on YouTube.